Whether you're a first-time buyer, a seasoned business owner buying investment properties, if you're self-employed looking to get a mortgage, this video is for you if you live in Denver, Colorado. Non-traditional loans. This one is really abstract, so I'm not going to get into the rabbit hole on it, but know this. If you own a business, odds are you want to take advantage of the tax code. If you want to take advantage of the tax code, as your CPA will tell you to, you're going to minimize income to reduce tax liability, right? Like that's what any good business owner would do. That's what investment properties owners are going to do. That's what I would look to do as a business owner myself. Take advantage of the tax code. If you've never read Tom Wheelwright's book, Tax-Free Wealth, I would highly recommend that book so that you're more aware. Don't just rely on your bookkeeper and your CPA. Be astute. I know your goal is to run that business and do it well, so you want to take advantage of the tax code. What does that mean for you? You might need flexibility when getting pre-approved to buy a home. So if your tax returns don't show the income and you don't qualify traditionally for that conventional, that FHA or that VA loan, what do? Well, there are lenders that will tell you, go claim the income, come back to me next year. But why would you do such a thing? The tax code is written for you as the business owner. We can qualify you off things like your bank statements, your 1099s, your profit and loss. Just be prepared that you're looking at a 10% entry point for down payment, though you can have some accommodations for your credit score. So if your credit score is lower, it doesn't mean you won't get the loan. It's just, is that the right loan for you? So be prepared on those types of loans because they will have a slightly higher interest rate and a slightly higher cost of borrowing. But here's where you have to think to yourself. Let's say it's $300 more per month for that loan than a traditional conventional loan. So $3,600 more in interest, okay? Would you rather pay the IRS, whatever that's gonna be, so that your income qualifies traditionally by those bank lenders that are telling you claim your income, or have more of tax shelter, take advantage of the tax code, write off what you know and legally that you can, and have more mortgage interest deduction. That's what these loans are all about, is the deduction and cash flow management. If I could put 10% down and I don't have to change how I file my taxes so that I can grow my business, it's more of a cash flow play than anything else. So keep that in mind when you're self-employed. On the bank statement option, we're probably looking at 12 to 24 months. From this, we're gonna analyze profitability with an expense ratio, and that's how we're gonna qualify you. It will give you more flexibility. Down payment, as I mentioned, 10% down, and I'm gonna give you that example of the payment. As an example, a $750,000 house. What if I told you it was 2% higher in rate? And maybe that's $900 a month. I know I gave some examples earlier, but $900 a month, so $11,000 more per year. Would that save you $11,000 in taxes paid to the IRS? Or would you be better served paying that money to the IRS or not? I would say that the business owners I talk to would ultimately say that they've been better served by not claiming the income, making the 10% down, because really it's about cash flow and money management over qualifying for a traditional mortgage when you know these options exist. This is a real life example of someone who owned a roofing company, okay? We went to qualify him traditionally, and based on his tax returns, it would have come down to about $40,000 a year of qualifying income on a business that was generating 7 figures a year of revenue. So ultimately, the decision was made to go with a non-traditional loan. The qualifying income for him, $40,000 a month based on cash flow from the business, of the business financials, and qualifying for that loan. They were able to buy their dream home. He was able to run his business from out of state, and they couldn't be happier. But again, you need to understand what you're giving up to what you're going to gain. And you got to think about the growth of the business versus protecting your cash flow versus the home that you know you can afford because you're told, quote unquote, you don't qualify for that. So when you're self-employed, keep this in mind because there are loans for you. Just prepare for a higher down payment, okay? If you're not sure if that type of loan is right for you, drop some comments below. Did you know that you can actually vest the title, the deed to the property in more flexible ways as well? And there's some debt ratio flexibility, up to 50% debt ratio on these self-employed loans as well. So this can be fantastic for you when you're a business owner. Thanks for watching. If you have any questions, post them below. Make sure you check out another important video along your home buying journey here in Denver when you're self-employed. Talk to you soon.